Okay, next we'll move to the role of alternatives and private markets in portfolio management. And to lead the host section will be Andrew Lockhart from Metrics and Adrian MacKenzie from 5V Capital.
Good afternoon, everyone. My name's Adrian MacKenzie. I'm here to present a few slides to maybe give some context and insight into private equity. I'll be followed by Andrew, and then we're going to have a bit of a panel discussion. I must say it's good to be back at the Hilton Hotel. The last time I was here was during COVID for 2 weeks quarantine, and it's quite a different experience, but hopefully the food's better. Just to give you a bit of an overview, you may or may not have heard of 5E. I assume not, but nevertheless, who are we? We're basically largely a kind of private equity, growth and venture capital investor. We manage about 1.5 billion under management. We have 22 team members. Biggest part of our business is private equity. We run venture as well. We invest about $300 million a year, but fundamentally, our business is underpinned by alignment. So the team at 5E, we're the biggest investors in our funds. We're very much believers in what we do, and so we invest about 11 cents in every dollar that we commit into any one of our deals. And just a small but very important point is we're a certified B Corp. We are investors. We are about making money, but we also believe in the broader community, and that's a great initiative that we bought into and we push out into our investee companies. We invest across a spectrum of businesses, from venture capital on the left through to private equity, as I mentioned, and that tends to be an age, stage, size and risk point of view. But I think fundamentally there's a few themes that we play into. One is that of growth. That's growth. How can technology help deliver that growth? And how can actually business performance deliver great returns? We don't use a lot of leverage in our investments. It's all about investing in high quality businesses with strong growth prospects that we feel that we can add incrementally to their prospects as we get involved, as we invest, and we help drive these businesses forward. I was told not to present this slide because it was not meant to be a pitch, but it does have some relevance to what I'm about to say later. And we deliver superior returns, and we've done that across a number of different funds. And it's actually relevant to the next few slides. So we'll take a bit of a moment to kind of point out the great returns, but I'm then going to give the proper context to them. I think the real discussion that should be had, and hopefully we can touch on in the panel discussion, is that alternatives, whichever way you cut it, alternatives are growing. All around the world. It's happening in Australia, but at a much slower pace. So on the left, you can see the growth of alternatives relative to other asset classes. But on the right, by any measure, Australia is relatively underpenetrated. And so we're not kind of making this up. This is a real global trend. We see it in many different asset classes. Clearly, I'm here to talk about private equity. But it's really about how do we kind of improve our reach and touch a broader investor base more successfully than we currently already do. I think another thing about private equity, perhaps to dispel myths, is that actually through cycles, private equity delivers superior returns. And the chart up here basically shows kind of performance through cycles compared to public markets, kind of before the GFC, during the GFC, and after the GFC. And each of those cases, vintages, you can see the relatively strong outperformance of private equity. But I think what's more marked when it comes to private equity is actually the difference between that manager selection has. There's quite a stark difference between the kind of top performing managers and then the bottom performing managers, and that gap narrows when you play in the public equity space. Now, what's the relevance of all of this, I guess, to the people in the room today? What we're seeing globally is an enormous push by some of the kind of most successful private equity houses globally, Blackstone, KKR, Apollo. an enormous push to basically tap into another investor class, being kind of like individuals. You know, the high net worth individuals, high net worth, super rich, high net worths, retail investors, cuts, minimums. There's an enormous push as basically these firms realize the significant amounts of capital that sits outside of the institutional platforms. I think Blackstone, for reference, Blackstone has a team of 300 people globally who purely focus on raising capital from retail investors for their funds across private equity, property, and everything else. And we see this trend happening. And you know, at 5V, we're spending a lot of time about thinking how can we tap into that, because you know Australia is a very sophisticated, forward-thinking market. You know, some of these trends develop overseas, but they do hit here. And they get embraced, and how can we, you know, be part of that part of the momentum that's building? And it's sort of interesting that we already do this to some extent, and this chart here is just simply a split of our investors by value. And the thing I'd like to point out is the kind of the blue and the green bar here. The majority of our investors, we are about 75% high net worth and family offices, 25% institutional. That's the case across all of our funds, despite the fact we've shown decent fund growth. But we tap into that high net worth and family office market. In fact, by number, about 80% of our funds comes from investors who've committed less than $2 million, and a very significant proportion is actually less than 500K. But that's within a closed-end vehicle. We found great success in going out, talking to people, telling them the story, getting them on board. But that's been a kind of a relationship of kind of like building and trust. But it's working. And you know, some of you may be aware, but we took an investment on from Pinnacle towards the end of last year. And a lot of the discussion we're having with Pinnacle is, you know, how can we take this further and reach a broader audience still? But as much as I like to think it's obvious, there's a number of considerations, and we will hopefully touch on some of them in the discussion. It's kind of like, well, why not here? And I guess, you know, the kind of, to jump to the conclusion is we're working on it, but there's a few things that we're trying to work through as we do that. You know, traditionally, it has been an institutional market for private equity. You try to tap into the institutions locally, or you try to go internationally. I think we've seen an ability to actually tap in beyond institutions locally, but it's how can we push that even further. The nature of the vehicle. All of our funds currently are closed-end vehicles. You know, we have a 5-year investment horizon, 5-year divestment, 10-year closed funds with 2 automatic extensions. Is that the right product for a broader market offering? The minimum ticket size, again, as you move from you know, kind of like institutional capital, we often find that the situation where we're actually too small for some of the institutions. They want to put such large amounts of money to work. It doesn't actually suit our strategy, our fund size, and where we want to play. And therefore, it's actually, we've dropped down, we've attracted a supportive audience, but how do we actually open that up again so it's, you know, more broadly attractive to people? You know, returns versus illiquidity. What is it you want? And I guess we live in a world, and I'm, you know, kind of susceptible to this. You want to have your cake and eat it. But in actual fact, one of the reasons private equity can deliver outsized returns is we're very patient. We can pick our moment. We can pick our time to invest. But probably more importantly, we can pick our time to sell, to divest. And that patience and the ability to bide your time really helps deliver outsized returns, and as the earlier slide showed, and that happens through cycles, good and bad. And therefore, you know, to deliver those returns, we need to have patient capital. How do you reach into a new investor base where, you know, illiquidity is something of a stumbling block for them? How can you address that issue? And there's ways that you can move some way towards that, but it's not clear cut. This is not a sort of public market proposition, and you know, we don't profess to be that, but we like to put our returns up and say, but the quid pro quo for the illiquidity are these excellent returns. And we are, like the rest of the industry, we are judged on our cash-on-cash performance. And we stand by that, and that creates that alignment with our investors. but in return, they're willing to be patient with us so that they give us the time to deliver those returns. But for a broader audience, how can we crack that particular conundrum? Capital appreciation versus income is really a subset of the point above, I guess. We are very driven by capital outcomes. We'd much rather reinvest in businesses to the extent there's any debt, pay off debt, before we get to income and dividends. It's actually about investing in great companies, driving their growth, to deliver an increase in value that we realise at some point in the future. So we are very happy with sacrificing income on the way through to do that. But does that sit properly or well with a broader set of investors? Deal flow and investment pace. I think that, when you invest in, say, the stock market, your money's working immediately. Private equity is a bit different to that. And therefore, kind of how is your money working? When is it working? Are you comfortable with the rate of investment? And I think that does mean different things for different managers. It goes back to manager selection or the particular part of the market that they play in. But is there a product that basically delivers a strong investment pace that people feel that their money is actually genuinely working for them, avoiding large cash drags, and sitting on the sidelines when it could be, elsewhere generating, maybe different, but generating returns? Local versus global. We do see locally a lot of money being put into the big international firms, and that kind of irks us somewhat. There's no reason why we can't do it for local firms here, but the likes of Partners Group and some others, they're showing that this is actually possible. This product's out there, but it taps into a very different market. And one of the things that we like to think is with local resonance into some of the businesses that we're investing in, people can get access to great private market opportunities, some that they may be familiar with or have heard of, and it doesn't feel like some sort of like far off concept. It feels much more tangible and real because of that local nature. And then ultimately, I guess, valuations, which ties into illiquidity and it ties into exits. We, like many of us in the industry, we subscribe to the international private equity valuations. There are guidelines in place. They are set by the manager. We have them reviewed by auditors. They can move up and down. But ultimately, in terms of kind of performance and performance fees, we're judged on cash and cash performance. So, whilst on the way through, you may, people do get valuations wrong. I think the most egregious mismatch in valuations has been on the venture capital side. I mean, we've seen that kind of unwind pretty significantly of recent times, both in the private space and in the public space. But how do we think about valuations? I think generally a conservative approach. There are guidelines out there, and ultimately you're judged on your true performance, not just on kind of what does it look like on a piece of paper. So we don't have the answers. I think what I wanted to do was just quickly trot through these slides, pose some questions, and perhaps when we get into the panel discussion, happy to get some views and have some questions and address some of these issues. But we think this is a product, it's an asset class that should be successful locally. It's certainly something we're very interested in. We're taking a leaf out of the book of the big international players. There's no reason why we can't do it. What we've just got to do is come up with something that resonates more clearly with a room of people like this, and then hopefully we can come to market with something that's appropriate. Thank you.
Hello, I'm Andrew Lockhart. I'm from Metrics Credit Partners. Metrics is a firm that we established when we launched our first fund back in June of 2013. We're Australia's largest non-bank private debt provider. We cover 4 key parts of the Australian market. And why do we cover these parts of the market? Most Australian companies are unrated. They don't have a rating by S&P or Moody's. Australia doesn't have a deep liquid corporate bond market. So access to financing for most Australian companies is heavily reliant upon the way in which a bank might be willing to provide financing. And the corporate wholesale institutional parts of the banks that we compete with to provide financing to our clients really segment their market into these 4 key areas. Loans to corporates, ASX listed and large private corporates, project and infrastructure related borrowers, leverage and acquisition finance transactions, and also commercial real estate. We are active in all of those areas, and the beauty and the thing that I would like to sort of leave with you today is what is the attractiveness of the asset class for client portfolios. And I heard Adrian say, and I agree with him, he's invested in equities, private equity for capital gain and growth. If you think about where you sit in the capital structure, obviously you're investing in equities to gain the benefit of earnings growth and capital gain. You invest in debt to gain the benefit of stability of capital, protection of capital, but also to generate an attractive source of income. And so when I think about our activities, the 2 things I'd like to leave you with today is to think about private debt as being an asset class that does truly deliver that stability of client capital, investor capital, but also delivers an attractive uncorrelated source of income. Now, why do I say that there's stability of capital that can be provided through the asset class? Well, it's important to not only think about where you sit in the capital structure. Obviously, equity is the first asset class that bears the risk of loss. So any deterioration in the financial performance of a borrower is borne by the volatility or the value of equity, shareholders' capital. You invest in debt to gain the protections through appropriate lending terms and conditions, imposing covenants, controls, taking security, monitoring and managing the risk associated with providing debt, but also to structure the long-term sustainable capital structure of a company that ensures that equity volatility does wear the risk of loss. So if you think about a company that might say trade on 10 times earnings, as a lender you'd be looking to say maybe provide debt of say 3 times. So effectively ensuring that there's a substantial amount of capital in the capital structure that can absorb that risk of loss. I think one of the things that's also often misunderstood in the Australian market is Australia has probably one of the most protective corporate insolvency legal frameworks globally. The interests of a secured creditor rank in priority to all other asset classes and creditors of a company. And so if you think about times where there's been volatility in the market, you think back to the GFC or you think back to March, April of 2020, companies raised an awful lot of capital, destroyed shareholder value, did deeply dilutive equity raisings only to restore their balance sheet. The risks for an Australian company corporate director to trade whilst insolvent or to take any risk in terms of the performance of that company obviously exposes them to quite considerable personal risk. So again, I believe that when you think about the Australian market context, you think about it in the context of the lack of alternatives away from the banks. You think of also the protective nature of the Australian corporate insolvency legal framework and the low or more conservative bank dominated nature of transactions that are completed in our market compared to some of the excesses that we see in both the European and US market. I believe that Australian corporate credit, private debt in the Australian market delivers a better risk-adjusted return than in other forms of private debt globally. And that's because of the unique nature of our market. And it's also a function of the fact that we do have an immature debt capital market that is dominated by the 4 domestic major banks. But the corporate insolvency and legal protections afforded to creditors is obviously paramount and also delivering that stability of capital and protection. It does deliver an income that is attractive. The majority of loans in the Australian market are priced off floating rates. They tend to be short-dated exposures. So certainly from our perspective, we would prefer to lend for shorter periods of time, generally between, say, 3 to 5 years. And the reason you do that is to lower investors' risk to credit risk. You're lowering investors' risk to changes in credit spreads. You're also increasing the level of liquidity across the portfolio of loan assets that you provide. But you also have the opportunity to recycle that capital whereby you charge fees that generates an income for investors. So the source of income to an investor in private debt in the Australian market, unlike the risks that investors have seen in traditional fixed income where duration has impacted adversely client portfolios, has delivered not only capital stability, but immediate participation in rising interest rates. And so I believe that when you think about the Australian market again, if you think about the public markets, often investors here have limited opportunity to get exposure to their defensive or to diversify their portfolios in defensive portfolio allocations. Often it's sort of government, semi-government or financial institution bonds. The direct private debt exposure in the Australian market does give diversification across a range of industries and sectors and companies. And obviously, one of the things that protects an investor capital most of all is to protect against the risk of credit loss. And so it's very important that a lender has a substantially well-diversified portfolio where you limit any one individual counterparty exposure. And so you want to have a low level of exposure to any one individual borrower. Where are we today? I think we're in a very attractive environment for a private debt manager in the Australian market. The Reserve Bank and the government over the pandemic period, last 2.5 odd years, made the markets or allowed the market to be awash with capital, liquidity. The Reserve Bank provided access to cheap financing to the Australian banks, and they used that to support the activities of Australian companies. Obviously, that facility has ended, and now the banks are subjected to increasing costs of funding as they look to refinance their exposures into wholesale funding markets, increasing their cost of funding. It's very difficult for the banks to make the required return on shareholders' funds in corporate debt when they're exposed to rising costs. The banks are exposed to rising costs and rising regulatory environment, or an impacting regulatory environment, making it again a less attractive market for them to lend. Most Australian banks have skewed their portfolios heavily towards consumer lending and small business lending, leaving the larger corporate borrowers to fend for themselves in gaining access to capital. So that tightening in liquidity, together with the increasing cost of funds and increasing regulatory oversight, drives up the cost of capital. And as a result of that, what we're seeing in our market is tightening liquidity and widening credit spreads, which flow through to improve returns for our investors. I also think that in times when liquidity is tight, we also have a situation whereby terms and conditions available to a lender are enhanced, and so that pendulum very much swings back in the favour of a lender. And so the key skill set to be able to deliver this for investors is the capacity to originate transactions. Often we hear people talk about the illiquidity of the asset class delivering a premium. I don't believe in that in any way, shape or form. It's about the skill set of the lender to be able to build good long-term relationships with companies, to deliver a service and to differentiate their structure and the terms and conditions upon which they finance the company and differentiate it to other parts of the market that allow you the opportunity to lend. You're seeking to ensure that the provision of a loan is just not commoditised. It's a skill set to be able to deliver financing in an appropriate way on terms and conditions that will be acceptable to the borrower. That capacity to originate a transaction, negotiate the fees, negotiate the margins, to understand what are the risks that need to be mitigated in the financing structure are very important, and then in terms of documenting the transaction to protect investor interests. I believe also an appropriately skilled manager has to have good workout and credit reorganisation, restructuring skills to manage through periods when economic or business conditions become more challenging. So again, if I think about the particular asset class, it does provide a range of attractive features for investors to gain access to, but the biggest risk that an investor is obviously exposed to is the risk of credit loss in the event of a default. So how do investors gain access to it? The asset class has become widely available. We often hear different investors talking about manager XYZ or others setting up business here in the Australian market to provide investors with access. But I think one of the things that's very important is to think about it in the context of it's a very wide, broad market. One end of the spectrum, you can provide investors with exposure to senior unsecured investment grade credit that would be equivalent to a traditional bond. At the other end of the risk spectrum, you can provide investors with exposure to higher yielding debt through mezzanine or subordinated debt or holdco facilities, or where the manager can also seek to provide investors not only with an attractive source of income from the debt through a high yielding piece of capital, but also using their skill set to negotiate, say, equity options or warrants, or taking a profit share, and recognising the value of the capital that is provided to that company. And so I believe, obviously important to gain access to appropriately skilled teams that have invested substantially in risk management, origination capacity, and the ability to manage both the origination and also the ongoing risk management activities. And why I believe all of these things are relevant for client portfolios, if you look back at publicly disclosed data, this is Vanguard data that goes back 20 years, and you'll see the extent of volatility that investors have been exposed to in public market investments. Often we hear the need to invest in growth assets to deliver outperformance for client portfolios, but often unless you're a very strong stock picker, the average performance delivered for client portfolios has been pretty ordinary over 20 years, without any one of those individual asset classes delivering in double digits and exposing investors to substantial risk of drawdown. I do compare and contrast it just quickly in terms of our own funds. You'll see there the absence of downside volatility and delivering, I believe, an attractive source of income. And so you invest in debt to gain the protection of capital, stability of capital, but to deliver an attractive source of income. And investors can determine what is their risk, what is their risk tolerance, what is their return objective, and then how do they wish to gain access to the asset class through liquid vehicles. And so as the asset class grows in size and scale and managers' portfolios become larger, then the opportunity to gain enhanced liquidity to the asset class, I believe, is available to clients through well-structured, well-managed client portfolios. But equally, what this particular slide shows is the difference between, say, a defensive portfolio allocation where the yield is, say, around 3 to 4% over the bill rate, comparing that to, say, a more aggressive structure in mezzanine or subordinated debt, where you'd be looking to generate currently in the current market anywhere between 15 to 20%. We obviously encourage people to ask more questions. If you have any interest in what I've said, feel free to either go to our website, get in contact with us, or follow us on LinkedIn. Thank you very much.
Can I just ask David McDonald from IMAP to come up as the moderator? And David, I'll have to get you to stick to time on this one. We seem to be a little bit over. There's still one more session to go at 3 p.m. and then people need to leave at 4 for flights and a whole lot of other things. And of course, two other leaders in the research and investment space are on this panel too. Jonathan Ramsay from InvestSense and Kyle Lidbury from Perpetual Private.
Thanks, Vinny. Okay. We've had two, I guess, almost different asset classes within the alternative asset class, if you like, there. And, alternatives also, sometimes people talk about commodities, hedge funds, all sorts of other things in there. We'll try and stick to what we've heard about. And perhaps, I think there are two questions. The first one probably is, should we? And the second one, which Adrian particularly touched on, is can we? And I recently saw there was an update from the Future Fund. They've added to alternatives, and they noted they've got 17% of their fund in private equity. Now, perhaps the Future Fund's not the relevant benchmark for people that need more liquidity and so on, but it's often something that people follow for ideas. So perhaps Kyle and Jonathan, if I could start with you, just the asset class as a whole, alternatives. Is it something we should be in? Are you talking to clients just in the sort of teens range that the Future Fund's looking at? And are you perhaps more or less positive than you were a year or so ago?
Yeah, I'll go first, but why do we do it? And I think it's worthy to sort of think about just fundamental principles around what we're trying to do for clients. We're trying to plan for clients for a given outcome, and the more certainty we can have on that future outcome, investing in inherently uncertain asset classes, it makes the planning process more effective, right? So why are we adding to alternatives? We're trying to build a more resilient portfolio. We're trying to build something that will increase the certainty that we can deliver for those clients at that given outcome. And ultimately, that's what we're trying to do, right? So I think as you know, and we've heard on numerous occasions, like the private and unlisted asset sector is growing. You know, so there's actually been a decline in the number of public listed companies, and there's been enormous growth in private markets. So this is increasingly becoming a larger part of our investable universe. And you know, if you look at Katie's presentation and going forward, that condition of more volatile markets, more difficult markets is going to be absolutely, a lot more difficult for clients going forward to plan. We're going to have less certainty on outcomes, more risk and more drawdowns. And so it's really, and higher inflation also means the importance of delivering for clients is going to be important. So if we can access other asset classes, not traditionally tied to market betas in equities and bonds, and get more certainty around that return, that's why we're investing here, right? Or that's why we invest here. Jonathan?
Well, given that it's IMAP and managed accounts, I think the first thing I'd say is you can, and there's a way, and I'd say especially if you've got a bespoke SMA program, SMAs are perfectly suited to having illiquid alternatives in there. Because unlike a super fund, you've got no member equity issues because you've got different unit price for all the underlying assets. So if one does get locked up, because that's the risk, that's the sort of, you know, Kyle was saying, the corner you've got to think around, it doesn't affect the rest of the portfolio. So that's the sort of yay kind of part. The slightly more boring reality for SMAs that are widely available is that you've, well, in fact, all SMAs have to have a shadow portfolio. So if you're running a bespoke portfolio, you can, but you have to manage it very carefully, the cash flows, especially if you've got some big clients in there, because it can gung up the system a little bit. That's just the platform functionality. And if it's one that's more widely available, our own view is that it sits outside. It's something that you may well want to do, but it's a sleeve that sits outside, because not only you've got the shadow portfolio thing, which is a real constraint, but this is something that's built for many investors, and that kind of illiquidity might not be suitable for all investors. And also the reason why, one of the main reasons why SMAs are becoming so popular is reducing the admin constraints on advisors, and you don't have to write an ROA for that. So that all kind of works. And then I've got a few points on the sort of thematics, but around illiquidity. Do you want me to continue, or am I getting nods?
Maybe we'll talk about illiquidity and access a bit later, and maybe just sort of keeping it a bit broader to start with. And I know one of the things we've heard is that people have talked in the last couple of years with you don't get anything out of bonds. Equity markets were getting to perhaps scary levels, and you know, liquidity was plentiful. So alternatives, and particularly maybe things like private equity, venture capital, and so on, were attractive. I just wonder, you know, in an environment where rates are rising and perhaps have risen again in the last couple of minutes, I'm not sure, what impact, I mean, maybe Adrian, something you can talk about. Do you think that could slow the liquidity flows into the asset class?
No, I don't think so, because it's a question of margin. You know, it's kind of like rates are going up but to what extent? I think we think about interest rates slightly differently, which is, you know, kind of twofold. One, you know, increasing rates are driven by uncertainty, or creating uncertainty in outlook. So how do we factor that into some of our assumptions when we're making investments? We don't use a lot of leverage in our investments, so it's not a kind of concern for us, a highly leveraged portfolio. But, you know, it's much more indicative of an environment that's out there. How do you react to that particular environment? And assume that you kind of like your investment pace or your investment decisions are reflecting, you know, as best you can what you see going forward from here.
Okay. And Andrew, I gather from your presentation, probably the other end for your funds, you're suggesting that, you know, rates go up, it doesn't matter, it all flows through. So everything's floating rate and it's pretty much immediate impact. Is that a fair comment?
That's correct. So there are a range of things that a lender does to protect and preserve capital, one of which is having exposure to floating rates, short-dated exposures, as I mentioned, but equally we have ratchets, like what we call pricing grids. So if credit quality was to improve or deteriorate, the margin will ratchet based on the credit quality of the borrower. And of course, the key to our asset class in terms of delivering returns is actually an investment in direct origination, the capacity to have those relationships that drive the ability to find good lending opportunities and then deploy capital in a sensible way. So, but if you think about the experience that a lot of client portfolios have had of recent times, is obviously managers have got duration wrong, and now investors have lost capital. And those that are now stuck in those investments are generating a very poor yield. And so I think one of the things that's quite attractive in our market is the fact that you're providing funding where capital is scarce. You're taking advantage of market inefficiencies. And so right at the moment, for instance, the banks have had a clear position over probably the best part of the last 5 to 7 years where they've really withdrawn from financing commercial real estate related activities as they've deployed their capital more onto the consumer home loan side. And as a result of that, access to capital is restricted, and the returns that are able to be delivered for investors through directly lending for those activities has been quite attractive. I think in our own funds, we're now yielding close on 9% for first registered mortgage, short-dated, secured property loans, which I think on a risk-adjusted basis is a very attractive position.
It's interesting. Carl?
I'm also curious. I mean, obviously, the increasing rate cycle, if you've structured those loans, you're actually getting that increase in yield, which is great. But you've also got the other side of things, which is the prospect of defaults and an increasing default environment. I mean, these are unrated borrowers. How do you, because that, despite earning the higher interest rate, you're earning that interest rate because of that risk. We haven't really seen a default cycle in private debt in Australia yet, I heard what you were saying in terms of the protection of the Australian cycle, but the other side of things is, will governments come out to bail banks and things, will they do so for private debt providers as well?
I think one of the advantages is that as a private lender, we're not regulated in any way. We're not required to hold regulatory capital against the assets. We're not levered. So a bank often, because of the regulatory capital that is required to be held against their assets, if credit quality deteriorates, they tend to become forced sellers. Whereas our interest is to protect our investor capital through the cycle. And so, if you go back to March of 2009, I would say there's always a bit of a lag period between a credit event and then potential net write-offs for the banks. The banks started reporting this back in 2009. So March of 2009, credit losses peaked for the banks at 0.67 of 1%. Very low loss rates. And those losses were really exposed in areas like the Brisbane tunnels, Babcock and Brown, Allco, and ABC Learning Centres. So, a handful of borrowers. A lender that has a skill set, that understands how to structure appropriate terms, conditions, and to manage the risk, obviously, I believe, has a skill set that can protect and preserve investor capital. We're not interested in sector or macro calls. Every decision we make is based on what is the cash flow capacity that this company can deliver to service and repay the debt, and then what are the ways in which we can mitigate that risk to ensure that our investors' capital is protected and preserved. And that means not only having a focus on debt service capacity of the company, but also then thinking if the environment deteriorates, what is the potential risk to capital, and what are the ways in which we would exit to ensure that we get our money back.
I think and sorry to get sort of more thematic, but I think you sort of nailed a little bit when you talked about liquidity, and it has been a 10-year trend, and the quantity of money, liquidity, and the price of money have been low, and that sea change has happened. So I think it's rational for us to worry about what's around the corner. And I absolutely respect how you do it at a micro level, but I think it's incumbent on us to look at that and sort of accept the fact that liquidity is in some ways like selling a put. It's asymmetric risk. And there is a chance that for a while people haven't been asked to pay enough for that. And when that changes, well, you're going to have the 1 year in 10, like a bank loses money, and that's going to happen. So we have to think around these corners. And it's quite difficult because the ratings that we get focus on all the generalities. They don't really go into actually what is that 1 in 10, or in Australia's case 1 in 30 year event look like. But I think the green shoots are there, already. As rates go up, risk premiums are going up, and that becomes a more interesting thing for new investors. But and I'd appreciate Adrian's sort of comment on this. I think you'd have to accept with hindsight that people have overpaid for some stuff, certainly in venture capital and in buyouts. Multiples have gone up over the last 10 years. This is all part of that sort of tidal change. But it must make for a better investing environment for you now, because people, recipients of capital, are actually ready to do more with it and probably a little bit less demanding at the margin. How do you balance that with the fact that you've got a lot of invested money in that prior regime, but the conditions are getting better? And how does an investor?
Look, I think our job is not to pick the highs or the lows. We've actually got to invest through the cycle. And therefore, what you have to do is, keep up a consistent pace, but then adjust your approach depending on how you're feeling or how you're seeing things. And so it's not kind of like the same approach in all kind of market conditions. And therefore, at the moment, we think a lot about kind of, wage inflation within companies, portfolio companies, both existing, but some of the investments we're going to make, kind of what's their ability to push prices through to offset, what's their reason for being, what's the competitive advantage, can you sell value, not cost? There's a number of different things that you factor in going forward. So we do look at it, I think, if we look backwards at our existing portfolio, we don't use a lot of debt, so we don't have those stresses in place. We do use modest leverage. We do use Matrix. They're an excellent partner. But we, and so I think it was some of those decisions around business quality rather than financial structures driving outcomes, that standing us in good stead as the kind of cycle's changing. Going forward, I think the attractive thing is that the kind of marginal dollars left the system. And that basically means that capital's become more scarce. And therefore, if you're staying the course and you've got capital available, then there should be opportunities, and we certainly feel that that's the case. But we're certainly not smart enough to pick our timing. Kind of like you get in when things are at a low and out when things are high. You've got to be quite consistent. But the chart that I put up in the slide presentation is that through cycles, private equity outperforms. It's not just kind of in one environment. It really is in all environments. But the kind of the circumstances and assumptions can change, and you've got to adapt to that.
Yeah, Adrian, that's interesting. Talking about opportunities, I mean, we've heard today about the big super funds, rather than buying a share in an airport, they're buying the whole airport, and so on. They're getting so big, they're having to do that. I mean, does that present more opportunities for someone like you lower down the scale? There are things that are basically too small for them now, perhaps.
Look, I don't think that the reason why the big institutions invest in these big assets is simply they've got a ton of capital and very few people, and there's very few homes they can actually put it to work, particularly in the kind of an asset class infrastructure where they feel that those longer term risk-adjusted returns are attractive to their member base. They've never really played, particularly in the Australian context, down into the kind of, and particularly where we play in the kind of small mid end of the private equity market. But it's really, you see a lot of activity in those perceived more stable asset classes like infrastructure and probably property, maybe a bit less these days, but certainly historically very aggressive purchasers of longer dated properties.
I think there's another side to that as well in terms of the capacity for Australian private equity firms to take on the amount of capital that's available in the institutional market. Like I think with real assets, you're talking about billion-dollar sort of asset pools. Whereas, and if you read the Keating-Kelty summary of 10 mega super $500 billion funds dominating the industry, to invest in a $300 million VC fund or a $1 billion Australian private equity fund is really problematic and doesn't really move the dial, right? And so I think Australian PE's actually got an exceptionally good record when you compare it to global, and I agree it's not necessarily had the support of the local institutional base, aside from a few players. What does that leave you if the institutional market's not really available? You sort of need to come down to the high net worth space and private client space, and then ultimately if you can tap that retail market as well, that's sort of where you have to go now.
Yeah, but I think it's a bit more nuanced than that, because in kind of like industry super funds, they've not played typically in private equity, but a lot of non-industry funds and a lot of international investors have. So again, we sort of scratch our head a little bit and say, well, why don't they do more of this? Obviously, kind of, focus on fees. In our view, is you focus on returns or net returns, and then scale, which is very difficult to put money to work, particularly in the part of the market that we play in.
The focus on fees is absolutely right, but I think it's a focus on fees across the board, and for us, there is pressure on fees in traditional assets, and I think that's actually an opportunity to use a fee budget to actually allocate to alternatives. The challenge is, and I'd agree, it is a very under-researched part of the market, right? And so if you are looking to invest in alternatives, particularly if you're not looking at any structures in retail, which there aren't a lot, right? I think nowadays with metrics and other managers, we are getting finally access to these types of asset classes, which is a great story for clients, but as an advisor, I want to allocate not just to one manager in a sector. I'd like a bit more diversification or a little bit more to choose from. So there's a lack of choice. And then in terms of going into that institutional space, it is a whole different world in terms of players and people that manage money, and how do you not only learn about them, but actually compare and try to work out who's the best manager. They're all fairly expensive on fees. And then the other side is if you do make a mistake, you might be locked up for 10 years.
Yeah.
And so then, so the impost on you to do your research and do your homework is a lot higher. There's a lot more work involved. It's more costly for your clients once you get in there. However, the benefits can be realised. And so I think that's the thing. It is, I think in some regards, investing in what we would call future fund or the real sort of alternatives asset class, this illiquidity premium, the inefficiency in private markets where managers can exercise skill. It's a real challenge to give access to clients in that. And we can talk about illiquidity too, because that just compounds it.
Well, just more generally though, history's not really on our side with introducing complex financial products to retail investors. So, I think, and that is the mistake that will be made. And I'd sort of push back a little bit on the vintage diversification thing. In that I think returns from private equity tend to be lumpy. And if you have the choice, and this is going to end up being a positive comment, because I think if you've got the opportunity, especially if you're designing a product now, if you've got the opportunity to be the one applying fresh capital, that's where everyone wants to be. If you're doing this over 20 years and you're a pension fund and you've got to do vintage diversification, absolutely, you stay the course. But if you're late cycle and you've got the choice, well, maybe why not go into the things that have been marked down a little bit that are, and why not start the journey now rather than potentially, and this would be the downside with a sort of all singing, all dancing, private equity has sort of a, normal liquidity but built-in lockups that gives you instant vintage diversification, that if we do have a rocky kind of year or so and liquidity does tighten, then you're going to find people in retail basically paying out other people who need the liquidity. And that's probably not something I'm that comfortable with. But if you come to me with something where you are putting fresh capital into fresh opportunities, then I think it's got a very different flavour. It's a little bit of a nuance, maybe. Is that a hopelessly naive perspective?
How to say in a nice way, yes.
You'd have to say in a nice way.
Yeah, like it's like how long do we have? I mean, I think it's kind of like and it does come back to things like valuations. Are you paying people out? It's the current fund structure that people are very comfortable with are closed-end funds, so you don't have that risk. But does a closed-end fund work for a broader audience? And so trying to design something that's perfect in all occasions is incredibly hard. And so I think it's much more around, what are anticipated returns? What are the risks? What are the benefits of that? What are some of the drawbacks? How does that fit within a diversified portfolio? And then pin your ears back. Rather than sort of saying the mechanism, because if we said to everybody, well, you can invest, but not have liquidity, that's perhaps, or the perception of liquidity, that's an even bigger issue for people. And what we're trying to do is really think about how do you provide access, and we can't keep everybody happy all of the time within that.
There's a fundamental lack of reality there, right? Like you're investing in structures that have 10-year lockups and trying to provide liquidity. And we need liquidity, right? We've got new clients joining the firm. We've got old clients leaving. The whole point of managed accounts is to run a portfolio that you can apply across your client base, and then you're running closed-end structures, automatically you're just not going to be able to maintain that as a model or as a managed account.
And people will want the most liquidity when there is the least liquidity.
Yeah.
That's
I think
Potentially,
well, certainly
Yes.
in our asset class, we've provided a range of ways in which people can gain access to it. But fundamentally, in private debt, it isn't a 5 or a 10-year lockup. You know, the average loan, say in our real estate debt fund, is less than 1 year. So investors are generating, you know, in that particular fund, close on 9% net of fees and costs, with a liquidity profile that matures every 12 months. We've got listed funds, we've got unlisted funds. We've designed funds specifically to cater to an investor's requirements in terms of what is their return objective, what is the risk that they are willing to take to achieve that return, and then what are the ways in which they can gain liquidity. Now, not all debt is liquid. You know, there are positions in our funds where we do take profit shares and we take options, or we hold equity positions, but we've got specific mechanics to deal to those less liquid assets in terms of our portfolio. But importantly, you know, if I really think about it, I hope that people are not allocating money to a traditional bond fund simply to lose money because you've got liquidity. At the end of it, return, risk management, they are the key things that people should think about. And they should be what drives investor decisions. Is the return objective being met? Have I got an acceptable risk profile to deliver that return? Have I got control over my money? As opposed to a portfolio allocation that just sees more money allocated to asset classes or managers that are continually losing money.
And I think Jonathan's points, I mean, for those of us that remember mortgage funds, you know, I think there's still that hang up in the industry, right? And they were absolutely missold. You know, they were being sold as TD replacements. So the importance around transparency, the importance of understanding liquidity. I don't know if we can ever get to a stage where people understand that there are funds in their portfolio that may lock up from time to time. Because the current understanding is that they, you know, if a fund locks up, just get prepared to wind it up because its life is done.
I think all you can say in those circumstances is people need to do the research, do the work to actually understand what is the governance structure, what is the skill set and competency of the people that are managing your money, what is their values and how are they committed to delivering on return and delivering on what they've stated for their investors. If I think about our funds, you know, we've gone. I would say we operate at the other end of the risk spectrum in terms of, you know, I believe our funds are subject to the highest level of corporate governance standards globally. You know, we operate ASX listed funds that require continuous disclosure obligations to be met. We have independent valuations that are undertaken on a monthly basis, independent testing for impairment. I believe we're completely transparent, and I think that's the reason why we've been successful in terms of being able to attract capital, to lower the cost to investors. All of the funds have delivered on those returns. I think when we established Metrics, we were very much looking to make a very clear distinction between the Australian market's poor experience in terms of debenture fund managers, mortgage trust managers, you know, people that expose clients to unnecessary risk in terms of derivatives. You know, think of basis capital. I think even the ASX listed funds that have come after Metrics funds, I think, are inappropriate. Most retail clients don't need to have foreign currency exposure in their fixed income portfolio. Most client retail portfolios don't need to be exposed to portfolios of CCC or lower credit quality. You know, there needs to be an education around what is the risk that people are taking to generate the return. People buy things based on a manager or a brand profile. And I think that's the big mistake that often gets made in retail advisory markets.
I know Vinny was keen for us to finish on time, and we're getting there. Maybe we'll just go to a few questions before we finish up. Are there any questions from the floor? There's right down the back, Toby.
Yeah, I'd like to ask Adrian about MacKenzie. Now, I know no one expects everything to work in venture capital, but I've got two questions. Firstly, are there any specific lessons that come given the circumstances of that situation? And is it a sign that there's more pain to come in the private and venture capital area?
Yeah, look, I think that's, it is a venture investment, so it's much more at the higher end of the spectrum. There's actually a limit to what I can say, but look, I think it's, the one comment I would make is that, you go into these investments with no guarantee of success. What you're trying to do is, assess a range of outcomes and hopefully deliver to those. And occasionally you get it wrong. So it's got to be a considered investment in the context of our funds. So for us, that represents less than 0.5% of our funds under management. And when it's, if somebody, wants to look at the loss compared to the gains we've generated, then the gains are far more significant. There is definitely more stress within the system, though. I think that's, we're now, and I make my comments very specifically and very clearly around venture capital, because you've seen, if you look at public markets, the biggest valuation resets have been in loss-making tech companies in listed markets, because the burning cash, access to capital has, for a long period of time was easy and available. That's no longer the case. So therefore, it's a bit of a kind of battle for survival. And so I would expect you would see more stress in that part of the market coming up, absolutely.
Other questions? Yep.
Andrew, just one question. You've mentioned that you have regular valuations and so on, but you also at one stage said that you had provision where the rate was related to the credit status of. Now, how often do you check that, and how do you check that in relatively short-term loans?
Yeah, sure. So what I was referring to there is a pricing grid. The pricing grid is documented at the time you enter into the transaction. That says, say the leverage at the time you've entered into the transaction is, say, 3 times debt to earnings. You'll have a range of criteria that say, okay, if it goes above 4 or 4.5 times, there's a default, but maybe between 3 to 3.5 or 3.5 to 4, a higher margin will apply. And then the same on the downside. So if leverage decreases, and so we're down at 2 times, the margin is already predetermined and set. And then every quarter, when the company provides their compliance certificate, they confirm what their level of leverage is against the net debt to earnings, and that is used to determine the appropriate margin that is then applied.
I've got a question for Adrian. Andrew talked about origination as the sort of first step in the private debt market. It struck me that origination in the private equity market is presumably also a significant challenge. I mean, how do you approach that? Is it a sort of business development process to find people who want to take on equity, or are there sectors that you say, right, well, we think the sector's got growth prospects, so we'll look for potential opportunities in that sector?
Look, it's a bit of everything. And when Andrew put his slide up, it's kind of like it starts with the origination, and it's not easy. We have a team who live and breathe it day in and day out, and so there's various different ways that we kind of look for opportunities. We have our relationships. We have, as I mentioned, most of our investors are high net worth and family offices. We actually get deal flow from investors, people that they know. My sister-in-law, I met somebody at barbecue, so we get deal flow from that network, which is a very powerful asset for our business. We have relationships with advisors. We tend to stay away from processes. We like to do bilateral deals. Every deal we do is with kind of family, founder, owner, entrepreneur. So how do you build relationships with those people over a long period of time? We signed a deal on Friday of last week that we've been talking to the founder for just over 2 years, building trust, building a relationship. We're taking a 65% stake in that business, and the founders are keeping a 35% stake. So you over time, it's really kind of like a complete sale. You're trying to build those relationships, and we're constantly doing that. We do have an origination function, so we have a couple of team members who just focus on that. We sit down as a team and we discuss sectors or ideas, or you see an ad on the side of a bus and it looks kind of interesting. What's that business about? So we're constantly kind of generating ideas and thoughts. We have a team that follow that up. They do that with an outreach program. We use our network as best we can. And if all of that fails, we cold call people and say, hello, we'd like to come and meet you. So it takes a fair amount of time and effort, but you do it for long enough, it bears fruit.
Any last questions? Yep, one last one.
This one's probably for Jonathan. I'll ask you. These sort of real assets or alternatives probably don't fit in a managed account scenario. So your suggestion was to hold them outside of that. That may not suit a lot of investors. But what's the alternative then? Because it looks like you're leaving asset classes. So you've got a liquids.
Yeah, so look, I mean, I think that is the reality. Unless you're running a bespoke SMA and you want to manage it very carefully, and you know that you tell certain advisors you're not going to trade at certain times and things like that. You know, say you've got monthly liquidity. That's as far as you'd probably push it. But you know, I'd say like for that concept of recreating an industry fund, you can do that. You can get the same risk profile, and you just have to report to the client, say, well, look, there's 30% there doing what the industry funds do, and there's 70% here, which is the liquid part, and I just sort of put it together. Yeah, maybe it's not quite as seamless, but you don't have to write ROAs very often. So, I think net, it kind of, that sort of works okay. And we actually provide some sort of modelling spreadsheets to allow people to do that.
Yeah, so it's probably about involving the managed accounts rather than sort of being that 100%.
I think it's evolution in the space, right? So you've seen it in infrastructure and real estate where you can run a vehicle that's got listed and unlisted exposures to provide liquidity. You're now seeing that with the Partners Group and Hamilton Lane structures that you see. So as more providers come to market, you'll get more client-friendly structures, and so I think that's part of the landscape as well.
Although I think what you're getting at, I mean, look, I actually do have a view because we've been caught out about this, fund of hedge funds, mismatches in liquidity. They get the most popular in 2007, and then I actually just, for us, we tend to advise steer clear of that. Keep, match the liquidity and talk to clients about it. Have an individual conversation, and that's the advisor adding value. I think the bells and whistles they can look great in normal times, but that's when you eat it later on.
Yeah, that's the other side of it, because you look at it and you're not getting the same exposure that you'd see in the future fund, right? So it has been not corrupt, corrupt is a bad word, but like it has been compromised in order to do that. You don't get one thing without the other.
But people only invest in top quartile funds. I don't know what happens to the lower quartile ones with this dispersion thing, but
okay,
there must be somewhere.
We better wrap up there, gents. Thank you, and we'll hand back to Vinny.
Right, David, Jonathan, Kyle, Adrian, Andrew, thank you for a very insightful session now.